Once again, hello everyone. My name is Kamal Manocha. I represent PMS AIF World. We are back with another Friday webinar. Today we have a very interesting guest, one of the thought leaders, in the equity markets, who has been delivering alpha throughout. Brings with him 2.5 decades of experience. Mr. Pankaj Morarka, you are formally welcome to this platform. We had set up this platform in 2019 to start understanding various strategies in the space of alternates, and we have interviewed almost every fund manager. But it is our fortune that we have got today to kind of discuss with you. I have been studying most of your funds since 2016. I remember you had started Renaissance in 2016, and most of your funds have been delivering alpha throughout, despite there have been tough markets in between. I was always wanting to do webinar with you, but there have been, I think, some off and ons. We did try to connect with you, but obviously we could not do that. So today is the day, and we do it really well. So we'll try to understand from you a lot of aspects about equity markets. Your views on equity markets is obviously a very simple thing, but that we'll cover in the end. But as the topic of this webinar is the science of equity investing today for sustainable growth over the next 5 years. So let's start, by hearing from you, what is your view about equity as an asset class today in the current context, in the current context of valuations, when we kind of want to apply science to it. Should we see it from the point of view of valuations, as a science, or should we kind of segregate it from the point of view of, say, PSUs and private companies, or segregate it from the point of view of large caps, mid caps, small caps? How should we apply science to it, and how does Renaissance, under your thought leadership, apply science and for the sustainable growth over next 5 years?
Sure, Kamal. Thanks a lot, first of all, for giving me this opportunity on your platform. It's indeed my pleasure to be doing this with you and talking to all your guests and uh, investors, audience who registered for this. I wish we would have done it much earlier, but for some reason it did not happen. And trust me, from the time as you know it, from the time I started Renaissance, last 5-6 years, I've been really busy trying to build an organization. We have traveled some distance in Renaissance because when I started, I was alone. Today we have a 50 people team. We have AUMs of 2,500 crores, and we have offices in 6 cities and all of that. So it's been and in between for a couple of years, COVID had its own challenges in terms of building business. So all of that did take a lot of time and energy in that sense. Coming to our topic of discussion, yeah. So I think let me give you a high-level perspective to you in terms of how I think about investing, and then I'll answer specifically the questions that you mentioned or you asked. See, I think I was very fortunate that I chose equity as a career way back in '96, and the only thing I've done over the last 26 years of my career is being an investor. And also, I've been very fortunate to work with and learn from some of the, I think, some of the best people and masters of the craft, if I may say so, because I believe investing is a craft. Uh, and these are, and where I'm saying where in the context of Rakesh ji, whom I worked with, I set up Rare, and he was a mentor to me all along his life and all of that. So where in his contact, I think, and some other people who are around, I think these are and where I firmly believe are the finest investing brains in the world. While they are the leading brains of India, but they also find. So I've been very privileged to learn a lot of things from there, and then evolve my own investment philosophy and approach. And over the years, what I really believed is people approach investing. Investing is as such one subject which has no boundaries. Meaning, in every field, when you take any field of science, let's say chemistry, biology, psychology, they have their own limitations. And beyond that, all the inventions, discoveries have been made. And their rules, and investing also, all of that applies to investing also. But investing is one field of science, I think, where you can just keep expanding boundaries. Because there is no single path path to reaching your destination. Everyone can take their own different path, and you can still reach the destination. So one logical thing is investors should do what suits them best. And I firmly believe that while people think, people, there are people who play momentum, there are people who do value investing, there are people who do growth investing, and all of that. I firmly believe that investing is actually a science, and which is what the meaning our logo says that the science of investing, Renaissance about science of investing is what. Because I firmly believe that while in investing, if we follow rules, then it leads to logical outcomes. So it might not lead to definite outcomes. So investing is not an exact science like, let's say, chemistry or physics, but it's certainly a logical science like biology and psychology. So I firmly believe that if one follows the principles of investing, the outcomes are logical and well defined. So investors, and one thing I've seen and learned in my career and seen, observed, read, investors who've been successful in Indian context, and I'm saying this also in global context. You think about all the investors who've been successful globally over the last 200, 300 years, all the great wizards of investing globally, and you study them, they all have their own principles and rules, rule book, playbook, principles, whatever you call it, and their investing outcomes, which is why measurable. You know exactly what this investor will, when you give money to that investor. So when an investor follows the predictable path or pattern, the good thing for the external world, especially for someone like me who manages third-party money, the most important thing for an investor is that our investment outcomes or behavior should be predictable. Because many times the biggest challenge investors worldwide face is you give your money to a manager thinking X outcome, you get Y outcome. That is because the behavior of the manager is not predictable. But investors who follow a logical defined path, their outcomes are always very predictable in that sense, because investing is a logical science. And I think which is what we exactly practice. I have practiced over the last, I would say, 20 years of my career. I built whole of Axis Mutual Fund over the last 10 years before I started Renaissance, that principles, and now we're trying to build Renaissance on the same principles. So first of all, the first common thing is, and then once you have that, then I'm saying these are all cyclical patterns. Large cap, mid cap, small cap, private sector, public sector, mean reversion, value investing, growth investing. These are all short-term patterns within the larger framework of your investing cycle, because an investor, a successful investor, will spend 50 years of career doing investing within that 50, 60 years. And probably why only 50, 60 years? Meaning Warren has been now, because he started at 16, he's 93. So he's had a 76-year career of investing. So this is one profession where you don't have to retire ever, as long as you're senile. So any investor having a long career will go through multiple cycles. As long as your own behavior, investing style, and principles are constant, the outcomes will be logical, and you will do well irrespective of the market cycles. Is the point I'm trying to say in a high-level context, in terms of there's some point of time where interests will rise, sometimes it will fall, sometimes value will do well, sometimes growth will do well. You want an investor who will do well across cycles of markets. And for that to happen, first thing when you want consistent output is consistent input. And the behavior of investor or the investing team or the investment process has to be very logical, predictable, defined, and cannot change with market cycles. And which is what which is what actually science is all about. So which is what we truly practice at Renaissance. As investors, our philosophy is very simple. We always growth bias investors. We are chasing growth and very high growth most of the time, because we believe over a very long period of time, let's say 20 year, 30 year, 15 year, there is a very high degree of correlation in the growth of the growth in profits and cash flows of a business and shareholder returns. So then logically, all of us want to invest into high growth business to optimize or to earn higher returns. But having said that, not all growth is equal. With growth, we also we want to invest into high quality business also, because quality is very important. And as long as we can buy those businesses at a fair price or a reasonable price, we are very happy. So we use a proprietary framework called SQGARP, SQGARP as we call it, which is about sustainable quality growth at reasonable price. So we want to buy growth, but we want to buy good quality growth, and we want to buy sustainable growth. So as long as we can buy sustainable quality growth businesses at a fair price or a reasonable price, we are very happy, and we think that defines us as an investor. And as long as everything we do has has to and does fall in that framework. And if we keep doing that, meaning our portfolios have done reasonably well over the last 5 years now that Renaissance has been around. And we think as long as there's consistency in our behavior, the output will be consistent, and which is what we actually focused on.
Sure. So, no, subsequent question that if I put myself in investor's shoes comes to mind is that yes, I agree with you. I would want to kind of believe with you that yes, investing is not an art; it is a science. Because yes, if one is able to understand the patterns in the past and is able to apply that in the future, obviously it becomes more predictable. It reduces the risk. Now, given this as a premise, what is your view with regards to macros? Most fund managers say that macros are only for entertainment, but those fund managers who actually ignore macros and only focus on micros have actually missed in last 2 years, and interest rates altogether moved up from almost 0% to 5%, and markets altogether changed from growth to value. And maybe same may happen in subsequent 2 3 4 years. So how to predict such things, which are like more macro driven in the context of taking equity investing as a science?
So, I'm of the opinion, and I firmly believe that we cannot ignore macros. I understand that if someone has permanent capital and you don't have to answer anyone, and if you are not bothered about your performance over a 3-year, 5-year period, and you just measure yourself, and there are investors who have permanent capital globally and they measure themselves only on 10-year performance. For them, macro becomes irrelevant. But for all other investors and investors like me who manage third-party money, my investors evaluate my performance, if not on a yearly basis, certainly on a 2-year, 3-year cycle. They don't give me 10-year time to evaluate, make a judgment on my performance. In which case, for any investor, I think macros are relevant because governments and central banks have a significant influence on the underlying growth of the economy and businesses. And meaning, this is my view. Last 20 years, the biggest hedge fund in the world is US Fed. They went from a balance sheet which was less than $500 billion to run the largest balance sheet, which is $9 trillion. And they own all sorts of exotic assets on the balance sheets. So when the largest balance sheet on the world behaves like a hedge fund, and while they want to and they control the money flow in the world, they themselves are extremely short-sighted because they can't predict inflation and their economy 4 quarters out. So meaning they got, and the most there, and I can count, I can give various examples of them. The most recent obviously is that they got extremely short, they got caught extremely on the wrong foot in predicting inflation in US when all throughout 2020 and 21, they kept on printing money at 2x the rate velocity was they were doing pre-COVID. 2021, when inflation rose globally and in US, they said it's a aberration and it will just soften because it's just because of reopening and a short-term demand, and this is not going to sustain, and inflation will come back and it's transitory or what they call it. And after that, we've seen in the last 15 months how they've been struggling to get moderate inflation, and the steepest rate hike that they've done in the last 45 years now is what we've experienced in the last 15 months. So the point I'm going to say is that when someone who's running the largest balance sheet in the world behaves like a hedge fund because they have no clue and clarity in terms of they control the world and they have no visibility, clarity, and they have all sorts of data. You and I, there's extreme asymmetry of information because the kind of access to information which they have, you and I or any investor in the world doesn't have, right? And yet they get their calls so wrong by such a wide margin. And on top of that, they at times they buy most of the exotic assets in the world. So then they certainly have an influence on global growth, cross-currency rates, commodity prices of every other asset class, right? Because they control the liquidity flow in the world. So I firmly believe that macros cannot be ignored. A good investment approach for a public manager is to have a right blend of have a top-down macro view. And then when it comes to building portfolio and stock selection, yes, obviously you have to be completely bottoms up. But you cannot do bottoms up investing or stock selection ignoring macros altogether. you have to take the macro environment into cognizance, because fiscal policies and monetary policies do influence and impact direction and pace of growth and value of assets.
Sure. So what does today's macro convey in terms of choice of sectors, allocation between equity and debt, or maybe fixed income?
So we are in a very interesting time, Kamal, actually, and I think it's very unprecedented, because most of the professional managers who are in their 30s and 40s, or probably in 50s, haven't lived through a time in their career that we are currently going through. Before I share my view, just think about this context. The world has completely moved 180 degrees between what the world was pre-COVID and what the world we are in at this point of time. So pre-COVID, between 2010 and 20, central banks globally, including the US Fed, were busy doing quantitative easing. And now post-COVID, the world is all about quantitative tightening. Pre-COVID, for 10 years between 2008 and 2020, inflation in US and the entire developed world was undershooting the target. So US wanted 2% inflation. Inflation was about 1.25% or thereabouts. And the Fed was struggling to get the inflation to 2%. So inflation was undershooting. Post-COVID, we are living in a world where inflation is overshooting, and they're struggling to bring it back to 2%, because it went to 9%. Now we are at 4% or 4.5%, wherever we are, right? So I think the world has completely changed over the post-COVID versus what we were living in the last 20 years pre-COVID, and so on and so forth. So in this context, my view is that one, I firmly believe that we are in an environment where inflation will remain elevated for the rest of this decade. For example, I don't think so US will get to 2% inflation, which is their target, before the end of this decade. I don't see them getting to until 2030. They will not get a 2% inflation, and which is why I think one, inflation in US and in the world, including India, this decade will remain elevated, which effectively means higher than what they were in the prior decade, pre-COVID world, which also logically means that interest rates in this decade will be higher than what they were in the previous decade. In a high or a moderately high or elevated inflation environment, unfortunately, fixed income is not an inflation hedge, because fixed income markets globally are distorted by central banks and government, because governments all over the world are the biggest borrowers. So they have a vested interest to keep interest rates low so as to reduce their borrowing cost. And they're doing that by shortchanging fixed income investors. And which is why fixed income is giving negative real returns all over the world. So the challenge for an investor is only the real hedge against inflation, I firmly believe, is either hard assets, which would be gold, real estate, because central banks cannot produce that, or equities, because at least if you're buying a growth equity, the underlying the profits of the underlying franchise or the business or cash flows are growing at 10-15%. So in an inflation where if inflation is 4-5%, if the franchise you're owning is growing their cash flow by 10-15%, at least you get an inflation hedge. How do you monetize that as an investor and convert that into your own cash flow returns is a separate thing, but at least your underlying asset is growing at a rate higher than the inflation. So there's a real return for you. Companies which do well in a high inflation environment are very different than companies which do well in a low or moderate inflation environment. Because in high inflation environment, businesses, most of the businesses are squeezed because their raw material costs are rising, and most of the businesses don't have the ability to pass pricing back to the customers, and their margins get squeezed. So essentially, companies or businesses with strong pricing power tend to do much better in a high inflation environment. And likewise, because inflation is high and interest rates are elevated, companies where valuations are extremely rich, they experience gravity because of rising interest rates. So companies where valuations or P's are extremely high tend to underperform, because there's a mean reversion in terms of their P's, and there's a gravitational force of rising interest rates. So the set of companies which tend to do well in a relatively elevated or high inflation environment are very different, and which is why what the point you were alluding to, the companies or the sectors which have done well in the last 2 years in equities in India and globally as well are somewhat different than what worked in the last 10 years. And I'm saying this, and which is why I said, you cannot ignore this fact of rising interest rates and inflation, and you have to align your portfolio to that. and investors who have not done that, their portfolios have underperformed. And I'm saying they'll continue to underperform for the rest of this decade if they don't align their portfolios. So my view is that businesses that one would like to own because we were talking in the context of next 5 years, are companies which are companies with very strong pricing power, companies with low or moderate leverage because interest rates are high, and companies with reasonable valuations. So companies with very high PE will underperform irrespective of their business performance. And I think this whole PE derating cycle, which has been going on in growth assets for the last 2 or 3 years, it has a very long way to go. I think it will continue for the rest of this decade.
Sure. So what are the sectors, within that framework of your kind of, approach, where you feel all these conducive aspects are more visible?
So we are sector agnostic, Kamal. But what happens is within sectors, we pick the right stocks. Let me give you an example. So last 2 years, the best performing consumer stock is actually ITC, where ITC stock has actually doubled over the last, I think, 20 months or so. And it has outperformed every other consumer stock. And same ITC was the most underperforming stock between 2014 and 2020, when every other consumer stock was. And for the simple reason that in a high inflation environment, ITC has a very strong pricing power because their raw material cost, which is tobacco leaves in their core business of cigarettes, is hardly a 2 or 3%. So any hike or increase in their raw material cost, they can very easily pass on to the customers without having any impact on their margins. In fact, in a rising high inflation environment, they take price hikes which are higher than what the cost in the raw material is. And as a result of it, their profit margins actually expands. So you go back in history and see over the last 50 or 100 years, 50, 60 years, whenever India has gone through a high inflation environment, ITC has outperformed lever. And whenever Indian economy has gone through a low inflation environment, lever has outperformed ITC. So I'm trying to say is, for example, it's not that we like consumer as a sector because Indian consumer story is the most compelling and the most exciting investment story over the next 20 years. Because we are the economy with 1.4 billion people, 29 years of average age, where the per capita income will go from $2,500 where we are currently to $10,000 over the next 15 years. This is an economic and consumer miracle. The same miracle happened in China over the last 20 years. And India is going to repeat the same economic miracle over the next 15 years. So you cannot afford not to invest into consumers in India. But then you have to invest in the right stocks within the consumer sector, taking into cognizance the macroeconomic environment, the tailwinds and headwinds for stocks which will do well. Because lever for last 2 years is zero returns, whereas ITC has doubled. So we like sectorally, meaning if you ask me, we don't have sector biases, we like all the sectors, but it's all about picking the right stocks in the sectors with our quality, growth, valuation. So the 3-tier framework we have is we want growth, we want good quality, and we want fair valuations, reasonable valuations. So we like consumer as a sector. I think we're very excited about Indian consumers. Meaning if you ask me, because Indian consumer is extremely underleveraged. He's young. His income levels are rising. And he's going to spend, he's going to invest. Meaning you just think about it, we produce about 400,000 IT engineers every year. These guys start their life at a salary of probably 7 to 8 lakhs. The first thing they buy the moment they get a job is an iPhone, 100,000 rupees iPhone. Within 6 months, they buy a car, and in the second or the third year, they're buying a house for themselves. Yeah, and India will keep producing 500,000 engineers for the next 15 years. Yeah, we're the largest producer of factory of producing engineers in the world. And the world needs software engineers from India because the world needs software engineers and we are the largest supplier of software engineers to the world. And these people, whether they're working in India or they're working abroad, yeah, doesn't matter. They remit money back home. Meaning I was stunned when I saw it 2 years back. I didn't expect this. Remittances to India now is the biggest source, is one of the biggest source of, is the second biggest source of foreign forex flow to this country at $100 billion per annum. So after IT exports, the second biggest inflow into the country comes from remittances from Indians living abroad, and that's $100 billion. Just think about $100 billion to $100 billion का exports करने में कितना time लगेगा? मतलब हमारे 70 years our exports are $400 billion, right? After 70 years of independence and all of that, और अब $100 billion के remittances आ रहे हैं हमें, and that number will grow at 15-20% every year, my view. Or 10-15% every year, because so many Indians are just working abroad. People are working abroad, they are doing well, they are earning more. So, sorry, cut the long story short, consumers we feel very excited about. I'm extremely excited about internet as a sector. I think the biggest wealth creation in India after the IT boom of late 90s and early 2000 will happen in internet sector. People, all of us are grossly underestimating the potential of internet sector. So I think over the next 15 years, the biggest wealth creation in India will happen in internet sector. Apart from that, we always like, we like healthcare, IT services, capital goods. We're seeing a revival of private sector investment. So we like all of them. It's just about investing into the right companies within those sectors, if I may say so.
Sure. Going back to the topic of this webinar, which is like, science of equity investing for sustainable growth. Now, if we apply science to equity investing, what is the logic of investing into new age businesses like Zomato, Nykaa, Paytm, and what is your view in that regards?
Very interesting question, Kavan. I'm very happy and thank you for asking me this question. I think these are businesses of future. I firmly believe this, and there is a very strong, imminent business case based on our logical investing approach to invest into businesses. Uh, uh, the fact is, we as consumers are going digital in our lifestyles, in our daily lifestyles, and it's visibly reflected. Let's say, until COVID happened, I didn't knew that there was something called a Zoom where you can do a video conference. I was not aware of it, and now Zoom is part of our lifestyle. We're doing this call, so we've gone digital. I'm a very old school traditional guy, given that now I'm old now. Yet I used to read my newspapers physically, and I like spend about 45 minutes reading newspapers, and I did all of that till COVID. Post COVID, I have moved to reading newspapers digitally. So a lot of things we are doing in our life, which we were doing physically, now we are transitioning to being digital as customers. And as a society, we are at a different stage of digital adoption. So our children are much more digital, and because they're born native, they're much more digital in their lifestyle than probably what you and I might be. Yeah, because they're born digital, and at early stage we push them to taking their school lessons digitally during the lockdowns and stuff like that, right? So if that is the case, businesses have to go where customers are going. So businesses have to become digital. Any business which does not go digital, I firmly believe, is risking its survival 15 years out. Just to give you some more context, for example, in something like China, 30% of luxury cars, I'm talking luxury cars, okay? So these are like the BMWs, Mercs, and Jaguars. 30% of luxury cars are sold digitally. The customer doesn't visit the showroom. He sees the car digitally. The car comes to his home for a test ride and he buys it. So if customers are going digital, businesses have to go digital. So I think the future of each and every business is digital. The good thing about a lot of these startups, let's say like Zomato as in case. So one, I think there's a huge business case for these companies because there is digital adoption. These companies fulfill certain services which customers like. For example, Zomato has a grocery business called Blinkit, which is instant delivery of grocery, right? Just think about it, modern retail, when it happened 30 years back with the advent of DMart and some of the other modern retail stores. Their value proposition was from going to a local grocery shop, which is unorganized. You go to a large mall, which is air conditioned. There's all the SKUs are arranged in a very nice manner in the alleys, and you can go there, have a walk, and buy all of those stuff. And it was a great experience. And plus, they were offering value, and consumers adopted to it. And modern retail emerged in India. Today's customer, because they're born digital, let's say your or my children, they don't want to spend their time going to the store, DMart store or Reliance retail store. They want the store to come to home because they want to use that 45 minutes or 60 minutes of time, which will take to go and to a Reliance retailer or DMart or Hypershore or whatever. They want to use that time to watch Netflix. So I think the next step in the whole retail evolution is the retail store, the organized retail store comes home, and which is what an instant grocery delivery is, Blinkit and the couple of others, all of that, right? So I think these are businesses of future because the customer, today's customer who's born today or the young generation, the next generation is born digital. They are digitally native. And over the next 15 years, they will become the biggest spenders in the economy. Also, other thing which I like about these businesses, think about, let's say I'm giving an example of a cement as an industry. Cement industry, one of the oldest industries in manufacturing, very evolved technology. There are some process improvements and technology efficiencies which keep happening every year, but the process of making cement is fairly evolved, established, has not changed in the last 70, 80 years that I have seen this industry or I've studied this industry. Yeah. In India also, after 70, 80 years, we have at least some 100 cement companies in India listed, unlisted, taken together, over 100 cement companies. So it's a sector which is fragmented. Now, when you talk about, let's say, when we talk about Zomato or we're talking about fintech, let's say UPI payments. So let's take Zomato as a food delivery, food technology. These businesses are just 10 years old. Zomato was set up in 2012 or 13. In 10 years, this industry has achieved oligopoly status. There are only 3 players versus a cement industry which has been around, which has 100 players. So consolidation in food tech has happened much faster than that has happened in the cement. In the first 10 years of the industry evolution, you have an oligopoly industry structure. Likewise, UPI, only 10 years old. 2013 is when UPI was launched. In 10 years, you have 3 players who control 95% of the UPI payments between Google Pay, PhonePe, and Paytm. So again, it's an industry which has achieved oligopoly structure in 3 years. One principle of investing, when we say about science of investing, now let me invoke one of the sciences of investing, is oligopoly industries anywhere in the world make above average profits. So whenever you see oligopoly industry structure in the world, where there is no government interference or intervention, the markets are free, and the industry structure is oligopoly, just blindly buy those businesses. This is science of investing. You apply your investing science to business. So, for example, telecom in India now is oligopoly. We went from 15 players to 3 players. 2 players control 75% of revenue and 120% of industry profit, because the other player makes 20% losses. So these 2 players now will continue to make above normal profits. So the good thing about this internet business is, one, they're very fast growing and will continue to remain very fast growing, because the current generation, young generation, who are the biggest spenders, they are going to use more and more of this, and their spending power is going to increase. Secondly, these businesses, because they're oligopoly structure, they're in the long term, their profit margins or profitability is going to remain very, very high on a sustained basis for a long period of time. And that really excites me about these businesses.
No, which is absolutely, quite interesting, and we all understand that. However, another aspect of science of investing also dictates that, companies should be making profits. But none of these companies, or maybe very few of these companies, are actually showing profits. Zomato has recently started making some profits, very, very meager amount. And there is always a doubt that, whether their large subscriber base will sustain with them when they will start to charge price. So obviously, going by this oligopolistic kind of a logic, I agree with you that yes, all those companies which have created moats and which have created oligopoly have obviously, created good margins because they have pricing power, they have brands. But these companies are yet to see, because they are trying to change the consumer behavior. And hence, from that point of view, there are mixed views. Obviously, you are on one side, but there are some old school fund managers. You also said that you are an old school fund manager, and you have applied kind of science to maybe take an entrepreneurial decision, which is like I would say, more of an art. That the way you have answered this question. So that's where I want maybe you to kind of give me a more in-depth perspective on how and why these companies actually will ultimately be logically seen in the equation of price to earning, or in the equation of sustainable growth over say next 5 years. Because obviously we are not just wanting to trade, buy today and then because of trend then exit.
No, certainly not. I think the ultimate test of value of any business is the cash that business generates. Yeah, because that's ultimately the business of business is to generate cash and give the cash back to shareholders. We are very clear in our investment philosophy and approach, and given my old school approach, that we will not invest into loss-making internet businesses, for example, because we don't have the kind of risk capital to give to a company which that company will burn by giving discount to customers. we can't give our money to any companies like that. So, and I must make a caveat that we are invested into some of these companies, including Paytm and Zomato and few others. So we are very clear that we invested into these companies when they achieved cash break-even. Because once you achieve break-even levels, the operating leverage in these businesses are very high. Yes, you're right. These companies have ceded significant losses over the last first 10 years of their life cycle, be it a Paytm or Zomato. But I think that was the cost of achieving industry consolidation. So if telecom was a 10 player and Jio came and they wanted to consolidate and make it a 3-player market, 8 players have to go bankrupt. Jio had to incur 3 lakh crores of capex and investments to make the pricing so low that everyone else went bankrupt. So in some form or other, either you seed losses or you make investments in the business. Any which way you count it, you have to make investments in the business to consolidate an industry. So UPI had 15, 20, 30 players. Food Tech had 7, 8 players. So last 10 years of their journey, they have ceded huge amount of losses, but I think that's the cost they've paid to consolidate the industry and achieve that industry consolidation in hindsight. And probably in some cases, there have been some misadventure and misinvestment by these companies also, which they've written off. But I think that we'll have to be kind enough to these entrepreneurs, saying that these guys did unorthodox businesses. They were innovating businesses. In the process, when you take 10 decisions, 1 or 2 will go wrong. So we'll have to be fair to when we sit on judgment, because 10 years back, there was no food tech as an industry, and no one thought that will emerge as an industry or a category, which it actually has emerged now. So that's one part of it. I think there's clear visibility from our perspective when we've done deep dive in most of these businesses, in terms of these businesses generating very solid cash flows, and more importantly, those cash flows growing at a very high rate over the next 10, 15, 20 years. These businesses have made rapid pivot post their listing and all of that over the last four quarters or 6 quarters, in terms of cutting down costs very sharply, improving efficiencies of the business, and likewise, Paytm achieved cash break even 2 quarters in December of 22 quarter. This year they'll do about something like 800 crores of EBITDA or thereabouts. Next year, I think my view is the growth sustains, which should. They will do about 1500 crores of EBITDA or thereabouts, and they can keep growing at 30-40% for the next 5 years. In fact, actually, I think they'll be the fastest growing finance company in India over the next 5-6 years. So I don't see why a Paytm cannot do $1 billion of cash flows. Probably, let's say, in somewhere between 5 to 10 years, 5 to 7 years, I would think. Why a Paytm? I mean, I'll be very disappointed where somewhere in the next 5 to 10 years, if Paytm does not do $1 billion of cash flows. And if that is the case, then today you can buy the business at about, I think, 7 billion or 8 billion, $7 to $8 billion. And from that framework, it looks extremely attractive. That a fintech business growing at 30-40%, potentially doing $1 billion of cash flows, 5, 7, 8 years, depending. I'm saying 5 to 10 years because it's a function of what growth rate we assume in our modeling when we do financial modeling for these companies, and we can have different assumptions, and which might have that, and everyone can have its own assumptions because these businesses are growing at a very fast rate. So we can make our own assumptions into the future, but I certainly think, irrespective of that, next 5 to 10 years, they will do that. Likewise, I don't see any reason why Zomato will not do $1 billion of cash flows over the next 5-6 years. You're right that as these businesses start charging customers for a lot of services which they've so far have given free, there could be some attrition, but that's fine. Customers who value those services will pay them. Zomato just few months back, or I think few weeks back, introduced a 2 rupees platform charge, right? Now, some customers might get offended with that and might not use it, but I think 95% or 98% of the customers will still stick around with them. And this 2 rupees is just the beginning. It's a given that this number is going to go higher and higher. Yeah, and likewise, I know when Paytm does payment services, a lot of services on the payment side which they were offering free, now they've started making it chargeable gradually in a step function where they're starting charging, and customers are paying. The fact is, I'll give you another context. The largest bank in India is HDFC Bank, private sector bank. Yeah, HDFC Bank has something like about 9 crore customers, if I'm not mistaken, 9 crore customers on a pan-India basis. Yeah. HDFC Bank, 97, I was the IPO investor during IPO, post-IPO. The fund I used to work with, we were amongst the top 5 shareholders of HDFC Bank. I've had a phenomenal phenomenally successful returns from them, and I'm really, meaning I would like to, I always thank them for the kind of work they've done for shareholders. Paytm is 10 years old. HDFC Bank is now 26 years old. HDFC Bank it took them 26 years to get to 9 crore customers. Paytm is 10 years old and Paytm has 9 crore customers. So they've achieved in 10 years, in terms of number of customers, what HDFC Bank took 26 years. So if they can monetize those customers by offering cross-selling and offering multiple services, offering services which are far more convenient, far more efficient, with a much better user experience, with customer at home, not wanting to go to a branch, at a cheaper cost than what a bank can offer, I think customers will adapt. And I think that's the future of fintech. So I really feel the more, meaning from my understanding, and I'm saying this, we've done very deep down, detailed work on all of these companies. The more I learn about these companies, and I must also say I have some understanding of technology businesses globally. I started my career in '96 as an IT analyst with UTI Mutual Fund. So I understand IT and technology, and it's been something which has been a sector which has been of great interest to me. So I've followed technology over the last 26, 27 years of my career. So I have some understanding of it. And when I apply those global inflection points when they happened in the Indian context to some of these Indian companies, I've come to a conclusion that all of us, including I myself, are underestimating the growth potential of these companies. So from a 5-year, 10-year, 15-year prism, I feel extremely excited. And trust me, we have our valuation models for all these companies in terms of what we think these companies can grow and growth and cash flows that can deliver. And I think the valuations eventually for any business, the ultimate bedrock valuation is the cash flows that the business can give back to shareholders. And I think on that metrics, I feel extremely positive, or if I may say so, bullish on these companies
Sure.
for the next decade perspective.
Sure, Pankaj. Thank you for giving all this insight. So another aspect which I noticed and observed in your in this conversation is you had mentioned the three sectors that you are bullish upon are consumers, and then you said IT, and then you said pharma. Now, interestingly, these three sectors are the underperforming sectors for the last 2 years. On the other side, the sectors which have actually performed are like manufacturing, infrastructure, real estate, right? But obviously, we know, these three sectors like IT, pharma, and consumers are good sectors. There are many companies, many names that come to mind, but they have actually been underperforming. So maybe there is some definite science that you're applying when you are saying, from the contrarian point of view, that these are the three sectors you are bullish about. So hence, I want you to elaborate this aspect.
Sure, sure. No, so we like manufacturing. We've been having big ownership in within manufacturing across autos and capital goods and auto ancillaries over the last 3 years, and they've done exceedingly well for us in our portfolio. So, and I'm a great believer in revival of India's manufacturing, driven by this PLI, rising manufacturing exports, China plus one, and that's driving India's manufacturing revival and all of that. So all of that stays, and we have ownership in companies and stocks across all of that. Having said that, yeah, right, I'm extremely bullish on consumer, IT services, including internet and healthcare. These sectors have underperformed broadly in the last 2 years. But I think probably we are near the trough of underperformance of these sectors, because I think as far as IT is concerned, the worst is clearly behind. The fears there was 18 months back in IT was that because US central bank is expected to raise rates very sharply, US economy will slip into a deep recession or a hard recession and something like that, and which will lead to contraction in spending by global companies in IT, cut in IT budgets for global companies or the Fortune 500 companies, which are the big drivers of IT spends globally, right? The fact is now 18 months out, we are at the peak of interest rate cycle. Probably we are either already peaked or closer to that. And the US economy is still holding very firm. And as a consequence, companies or the Fortune 500 companies which were holding back their IT spends and not taking decisions or deferring decisions, they've now started again moving into decision-making space, and decision-making cycle has started. The moment the decision-making cycle starts in US, a translation into business for IT companies and translation into the quarterly numbers has a 2 to 3 quarter lag. So in our conversation with IT companies here and some of the key stakeholders in global companies who take in IT spending decisions with the CTOs of some of the global companies and consultants, we clearly see this trend where corporates which had in US or global companies which were holding back the IT spends are starting to take decision making and starting to award projects and all of that. So we clearly think from a business point of view, we are at a point where IT is clearly troughed or bottomed out. And to reflect in results, financial results of Indian IT companies, it will take 2 to 3 quarters. But the business cycle has turned, which is very evident. And valuations in IT are today are 20-30% lower than where they were in Jan of 22 when the sector peaked. So valuations have moderated and growth cycle will restart, and that makes IT as a very interesting. So we have turned positive on IT. We were underweight IT for last 18 months, and now we have turned positive on IT. And likewise with pharma, we have actually gone overweight on pharma because we think the worst in terms of pricing erosion in US, which was hurting the profitability of pharma companies, is clearly behind. In fact, we see signs of stability in generic prices in US, and price erosions now are much more normalized, 3-5%, which they historically has always been. On top of that, there's been consolidation in the generics market in US, where a lot of unprofitable facilities have closed down, and there've been a lot of companies, including Indian companies, have been withdrawing products from US markets, products which have become unprofitable. So again, there's a clear sign that the pharma sector had a profit degrowth for 2 years in FY22 and FY23. The profit was declined each year. So FY23 profitability is tough, and from this year onward, the sector is back to profit growth mode. So we think from this year, we're already seeing signs of it, and it's already evident in the first quarter numbers that the profit growth is back in the sector. So I clearly think that over the next 3 years, pharma as a sector will do well. India has some unique advantages. 60% of generics sold in US are manufactured in India, whether they're manufactured by Indian companies or global generic companies, let's say a Mylan or a Teva having facility in India. So whether manufactured by global companies or Indian companies, but they're manufactured in India, the generic formulations are manufactured in India, because we have those advantage of low cost and US FDA approved plants and so on and so forth. So I think India has a strategic advantage in that sense, and meaning from here on the sector. So we have turned positive. We were actually underweight both these sectors for the last 2 years, and we have actually now turned overweight both these sectors in the last 2 or 3 months, because we think these sectors, the worst is behind, and we are seeing signs of recovery in these sectors.
So, what are your views with regards to this small weight sector, specialty chemicals, which has actually delivered good wealth creation for investors, and of late has seen fall in prices, fall in valuations also, because I think commodity prices are falling, and now again we see in last say 1 week it is again showing signs of kind of becoming again favorable sector. As per your knowledge and understanding of studying pattern and maybe the growth in the past with regards to some of these upcoming sectors, how do you want to kind of place your opinion with regards to specialty chemicals?
So actually, I think as a theme, we like the theme. Uh, one one big point of disagreement I have with the consensus is actually 90% of chemical companies and chemical businesses out there which are listed are not specialty chemicals. They are commoditized chemicals. And market makes this, stock markets do make error of judgment every cycle. And I think this is the error of judgment which market and market participants are making, is giving commodity chemical companies the valuation of specialty chemicals. They might do well in an upcycle, but when cycle normalizes globally, because last 3-4 years also businesses have been impacted and influenced by supply chain dislocations, sharp spikes in commodity prices, and likewise. So when business cycle normalizes, there's a mean reversion and things settle down, the terminal value of the cash flows of a commodity chemical company, the value that the market will ascribe or an investor will ascribe to that, it will be far, far lower than what one would like to apply terminal value one would ascribe to a specialty chemical company. Because commodity chemical companies, apart from being beneficiary of supply chain dislocations where there's scarcity of supply, so the customer will buy from anyone who's willing to supply, in a normalized business environment, they have no pricing power. They are price takers, and they cannot dictate and command prices. Uh, Meaning, 90% of the businesses of chemical companies which are listed in India are commodity chemicals. They are not specialty chemicals. So we own certain chemical companies, but we truly own the specialty, which we believe are truly specialty chemicals. Because
Sure.
if you're actually doing specialty chemicals, then you will retain a pricing power, because not many people can manufacture that. And that's either because the process is extremely complex, or you have some patents, or you have some innovations, or you have certain process efficiencies which cannot be replicated by competition, and that gives you an edge. And which is where, this is something like in the healthcare sector, somewhere having an innovator drug. So only the innovator has invented the drug, so he gets a pricing monopoly for a 10-15 years. Likewise, specialty chemical companies get command price for their products for a long period of time, 10-15 years. That companies doing chloroalkalis, dyes, intermediates, they are not specialty chemical companies.
No, absolutely. Your comment actually, has come because you are a CA. Most, fund managers are MBAs. That is the reason, they kind of keep saying they are specialty chemicals. Absolutely, 90% is commodities, 10% is specialty chemicals, and absolutely, that is a valid, comment. I absolutely agree with that.
So commodity chemical companies will be a play on rising volumes. Their volumes will grow multifold because there is a China Plus One, and global source customers want to diversify or de-risk their sourcing from, which is today 100% of their sourcing or 90% of their sourcing is from China, and they want to reduce that China sourcing from 90 to 60, 70 something. They want another source, and they will diversify, and India offers an attractive value proposition. So their businesses will grow in terms of volumes. But to my mind, their valuations will never command a premium. They will trade at a single digit or a low double digit multiple, and nothing more than that. They might get benefits of cycle where there is supply shortage of raw materials, and because of which prices of, I think there's something called, let's say, I'm just saying in the whole, there's something called H acid. Now, different points of time, capacities in China for H acid closes down, which is why H acid manufacturers in India have get a huge price benefit, and as a result of which their profits grows by 100-200%. But that does not make a company manufacturing H acid as a specialty chemical company. They get benefit of the price trend in a commodity chemical globally, but they are not specialty chemical manufacturers. So that's the point I'm making. We like specialty chemical companies, and which is where within the chemical sector we are invested into, which is why we have investments only into a couple of companies, because we believe that they're truly specialty chemicals, and we think that they will grow, and they'll grow, meaning they'll grow profitably, and the growth will be value accretive, meaning they'll do ROEs which will be north of 20%, and irrespective of the business cycles, because they will always command the pricing power in their business. So we like those kind of companies.
Sure.
That's what we.
Sure. Perfect. So, I'll ask you 3 more questions. We have 8 minutes more to go, because I know we have a hard stop at 5.
Sure.
So let's kind of, maybe keep the answers relatively short.
Sure.
Right. So what is your view on PSUs? As of now, over the last 2 years, PSUs have been performing really well, but I do not know what does science convey in regards to PSUs performing well.
So all of us know that most of the PSUs, the actual value of the business, for a moment, think about it, it's not listed on the stock market. The value of the business is significantly higher than the stock prices. The stock market has had a significant derating of stock prices of PSU in the last 10 years for multiple reasons. All of us are aware of it, including they don't like government ownership, government intervention, slow moving. There have been some governance issues. Some PSU banking as a sector has huge bulging of NPAs. We've had our own set of coal scams and all of that, which have had a negative rub-off effect on PSUs and all sort of things. I'm just saying. Yeah. And on top of that, government has done consistent OFS. So government has been a supplier of liquidity into these companies. And sometimes these companies have been used to have taken decisions which are not in the best interest of the shareholders, because they have certain other obligations as well. And all of that has led to significant derating of these companies. And they got also impacted to some extent by slowdown in the economy, which we witnessed post-COVID. I think clearly what we're witnessing in the last 2 years is value unlocking in these companies, in that sense, where we are seeing a better alignment of stock reflection of stock prices to the inherent value of the business. So, for example, you take the classic case of REC and PFC, the two companies which have been the best performing company over the last 3 months. Right now, these are companies which are trading at 0.2, 0.3 time price to book. Which was, and they're still doing 15-16% ROE. So for a company which is doing 15-16% ROE, and where NPAs are coming down, trading at 0.2, 0.3 price to book was damn cheap or extreme deep value. That's the extent to which they were beaten down. And now, because business prospects are improving, now we are seeing investors coming back to these companies after almost a gap of 10-12 years in that sense. So in that sense, I think probably there's a mean reversion. Because the value is beaten down so badly that they're reverting back to their mean valuations. And secondly, I think also it's to an extent driven by value unlocking. So I think the fact that government has done 2 public sector divestments, and as they divest more and more companies, I think there'll be re-rating of PSUs. Because then the markets will realize and acknowledge the fact that the value of these businesses are far higher in the hands of a private sector player than versus a government. So as we see that, government has done that with Air India. They've done 1 or 2 more smaller PSUs, and I'm hoping that the couple of bigger PSUs which are on the list do get divested soon, including IDBI Bank and BEML. So I think I think as the government, this is like go back to UK when Margaret Thatcher sold all the state-owned companies in UK. The common saying on the street, and one of the stalwart investor at that point of time said, Peter Lynch said, when the Queen is selling her jewels, you cannot not buy it. So these are great businesses, I'm saying. And I think somewhere market is recognizing the fact that they've been beaten down very badly in terms of valuations. And secondly, market is seeing that value unlocking happening as these companies get divested, and which is where investors in some form are coming back to this investor. We own some PSUs, I must say. We like to own companies which are, despite being PSU, which are leaders in their respective sectors. So for example, we own NTPC. We think NTPC is a leader in the power sector. We own REC. Because we found very deep value, and now they're coming back to growth curve and all that. So we won't select PSUs, but I must say we've been selective in our ownership of PSUs because we want to own companies which are leaders despite being PSUs.
The one thing which is very interesting and I think very good about your approach, as per my understanding, I have been interviewing various fund managers, is that you are absolutely having open mind. Many fund managers have a closed mind. Macros are entertainment. PSUs are bad businesses. New age companies, we can't understand. But absolutely, you have an open mind, to everything, and you are trying to figure out what is the opportunity. Absolutely, which is something which I am finding very interesting. You want to say something about this?
No, absolutely. That is what investing is all about. My job as an investor is to is to buy for my investors $1 for 60, 70 cents, 50 cents, 60 cents, 70 cents. With no biases. So I should be neutral in my opinion. And this is like, as I said, when we talk about science, we have to be clinical in our approach, So it doesn't matter to a doctor, to a surgeon, for a surgeon, a patient in an operation theater is a body. It doesn't matter whether he's his relative or not. He just has to be clinical. So whenever I look at any business, I look at it as a professional manager. And I have a professional duty to do to my investors. So I cannot bring my biases. I have to bring my rules, my science, my logic to it, not my biases. And I approach things very objectively with a very open mind. And my objective, the mandate which my investors have given or keep giving me is they want me to buy $1 for them for 50, 60, 70 cents. As long as I can keep doing that, I have discharged my professional obligation to them. So I just approach it very professionally, and as a professional, I think we just have to be very clinical about it.
So what is your not to do list? It will be interesting to know that.
Companies with poor corporate governance, promoters with checkered background, and I must say that I have burnt my fingers in companies with poor corporate governance, promoters with tricky or not clean backgrounds. Businesses where there is too much of government intervention, because then that really hurts, because government's objective is not profits of the business. As shareholders, as investors, we have to be capitalist. While we might have a human heart, but we have to be capitalist in our approach. So companies where business is not subject to too much of government policies or intervention. That's where we like to avoid, because then things can change overnight all of a sudden, and it has happened in the past. Again, I've burned my fingers in some of those companies and sectors. And finally, I don't like companies using too much of leverage. So companies with low or moderate leverage. Leverage is not bad, but too much of leverage, we don't want too much of balance sheet risk, because that can land you in trouble when there's a bad economic cycle. And finally, I don't like companies which do inorganic growth, because I want to give money to entrepreneurs who want to build business, not buy businesses. If it is about buying business, then that's what I do. So I don't want to give money to someone. I'm buying business and then he's buying business with my money. That's what I want. I want to give money to someone who's going to build business and not buy businesses. So we like organic growth. I'm a big fan, very big fan of organic growth. So
Sure.
these are the 5-6 things which I avoid.
Sure. What is your view, given your knowledge and study of valuations and, obviously applying science to investing, about the view about the valuations of small caps? Small caps today are again at the all-time high, and we have always seen that they kind of run in cycles. Investors who invested last time at the peak of small cap cycle in 2017 had to kind of wait till 2021 for them to actually recover their principal. And from 2021 also now, we have seen, these small caps delivering substantial returns. So at this juncture, what is your allocation of a portfolio to small caps, and what is your comfort with small caps?
I completely agree with you. I think I would say there's a valuation froth in small caps. There's a very high degree of exuberance where retail HNI activity is very high, and people are just extrapolating the present into future without understanding business cycles, and ignoring valuations, extrapolating one quarter's numbers to the next 40 quarters. And life and businesses are not linear. They're never linear. And when the economic cycle turns adverse, smaller businesses are more prone to disruptions, or the negative impact of the operating deleverage, even at the P&L level, is much higher for smaller companies versus larger companies. And their ability to withstand an adverse economic cycle, let's say a COVID-like crisis where economy was shut down. Let's say hotels is a sector. We used to like hotels. We like hotels. So the ability of Indian hotels to withstand 2 years of losses because of lockdowns and hotels being closed down far better than a lot of smaller hotels which went bankrupt. So I think there's a very high degree of froth in small caps. I would sincerely urge investors to be very careful in small caps. And I also agree with the point you made that whenever this small cap rally peaks out in the next few months, or probably and I don't think so this can continue beyond 2, 3, 4 months, the kind of frenzy we are witnessing, a lot of stocks will not see their current prices for the next 5 years. It will take at least 5-6 years for a lot of stocks, because I can see amongst the stocks which I track or I observe, I can see many stocks where their prices are, I would say, 10 standard deviation away from the mean for the business value. But the fact is there's a lot of frenzy and there are more buyers of the stocks. And I'm sure most of these people who are buying these stocks have no understanding of the business. So I think there's a lot of froth, enthusiasm, and frenzy that's already being built in the small caps, and one should be very careful.
So the last $1 million question: then how will wealth be created over the next 5 years?
Very simple. I've been saying this for last 26 years. From the time I started in 96. This one thing I learned in early stage of my career: people think investing into equity is a risk. And the risk is that you invest today, market peaks out, and you can lose 15-20% of your capital. But India being a secular growth story, if you stay invested for 2-3 years, you will not lose, because that money will come back and it will go higher, right? So the risk of investing in stock market is 15-20% if you're investing into a right fund and all of that. The bigger risk is not investing into equity. So I've been saying this: not investing into equity is a much bigger risk than investing into equity. Because if you don't invest into equity, there's no other asset class which can give you a return equivalent of equity over the next 20, 30, 40 years. India will be going through one of the best cycle of prosperity over the next 15-20 years. This 15-20 years of cycle plays out in every country in a once in a 100-year cycle. Every country gets that golden period of 15-20 years where they transition. Japan transitioned from being a low-income country to, they almost got to a stage where their per capita income was in a striking distance of US at the peak of their prosperity, and then they peaked out. China went from something like similar India, less than $1,000 per capita income, to today where they are at $14,000 per capita income. And India is going to go through this cycle over the next 15, 20 years. During this period of economic prosperity of any country, you have to invest into stock markets. If you're not investing into stock market during this period of economic prosperity of any country, is the biggest risk you run. So the only message I have is not investing into equities. The biggest risk, it's a much bigger risk than investing into equities. Idea is simple: just buy into equities. You plan do your asset allocation, plan your savings, and all of that, but have adequate exposure to equities and just stay invested. There'll be cycles. Something will go wrong, some part of the world, markets will fall and all of that. But every decline or fall, if you have money, savings is only an opportunity to buy Indian equities at a price cheaper than what it was before that crisis. So just stay invested into equities. Select your funds. If you can do it yourself, fantastic. If you can't do it, you can buy funds, alternate investment funds like a PMS AIF or mutual funds at a reasonably low cost or a moderate cost, I would say. And you can hire the services of best of the fund managers to do an excellent professional job for you. So just invest into the right funds and just stay invested. Have faith in India. I mean, that's my simple. Just one more thing. In India, we have this culture of a lot of people, traditional, our parents and all that, they buy real estate, home offices, and then they give it to your children. I'm saying my mentors have taught me, don't give your children real estate, give them stocks. Leave stocks for them, because the wealth creation out of stocks will be significantly higher than the wealth creation that will emerge out of real estate.
Sure, Pankaj. I think, whatever you have said was quite logical, quite scientific, and ultimately it reiterates the message that while investing in equities, hand over your risk to the fund manager, worry about returns, and have a long-term perspective. And absolutely on that note, we would like to end this discussion with you. We would really want to continue this discussion, but obviously, we have limited time. I have more questions coming to my mind, but maybe next time, we'll ask you a question that is a subsequent question which I don't want to ask now, but I'll leave you with that question, because what happens, investors who are our audience are equity investors. So it's not that they need to be told that you should be investing in equity. They understand, yes, there is a 15-year bull cycle in front of them. But as a nature, even if I put myself in any investor's shoe, the question that he would want to ask you is that if I have 100 rupees to be invested today, how should I deploy that? Should I kind of put that completely keeping in mind long-term view, or should I stagger it and try to time the market because small caps are at all-time high, Nifty is at all-time high, next year is an election year? So that is the question, which investors will always have on their mind.
Let me take 2 minutes to answer this. If you have time, I'll take 2. Yeah, because
you had hard stop, I thought.
Absolutely. No, but let me answer this for 2 minutes, because investors are here and we're having this conversation, and probably I didn't think about it, but yes, you're absolutely right. These are relevant questions for investors. If you ask me, okay, and I'm going to use an example of our funds. First of all, trust me, I don't time markets. So when I've run public funds now for 26 years, my investors do ask me how much cash you'll hold. I always give them an answer that if I can predict a crisis, timing of a crisis, I will hold 10-20% cash in my portfolio. In my last 26 years of career, I have not been able to time a crisis. I've lived through the technology meltdown of 2000. I've lived through the global financial crisis of 2007-8. I've lived through the currency crisis of 2013, when our currency went for a sharp depreciation. The European crisis in 2011 or 12, and finally the COVID crisis. Yeah, the 6-7 crises in stock markets and economies that I've lived through my career, I've not been able to time the crisis, which effectively meant in each of these crises, when I went into these crises, my portfolio was 95, 97%, 100% invested. And yet I've done well. My funds have done well over my 26 years of career at all points of time. So the point I'm trying to say is, timing the market, and my experience, all the successful managers I've studied in history over the last 100, 200 years, they have been bad timers of the market. So timing the market has not been the biggest thing which has led to the success of the successful investment manager over their career. What has led to the success is having the right temperament, making the right kind of investment decisions, investing in the right companies, buying those companies at a fair price, reasonable price. Most important, every investor, every fund manager makes mistakes. acknowledging and recognizing your mistakes in time and taking corrective actions, which effectively could mean at times you have to sell a stock at a loss. So be it. What can we do? You'll not get 100% right. But all the successful investors have had this trait of that they've been a great, they've been very early in recognizing and accepting their mistakes and the error of judgments, and they've been very vocal about it. They don't hide their mistakes. They don't think that कि अगर मैं ये मेरी गलती बता दूंगा तो मेरे इन्वेस्टर मेरे बारे में क्या सोचेंगे. No, they tell it very upfront कि yes, I made this mistake. They write in their investment letters, they write in their annual reports that I made this mistake on your behalf. So I think from a time, I firmly believe, I don't believe in timing the markets, but what you should do as investors is make sure, one, you're doing asset allocation right, and second, select the right funds. So for example, I'll give an example, and I say this, meaning I don't want to use this platform to market my funds, but when I market my funds, our PMS funds, our AIF funds, all our funds currently are at about 0.8 to somewhere between 0.8 and 0.9 beta. So I tell my investors, if you fear market will fall, we are the best guys for you, because we are running low risk portfolios. Our portfolio betas are 0.8, 0.85, which effectively means that when markets fall, our portfolios will fall much less. Our portfolios have downside capture ratio over the last 5 years of 50 to 70%. So every time the market has fallen in the last 5 years, our portfolios have fallen only 50 to 70% of what the market has fallen. So we have created anywhere between 30 to 50% alpha on the downside. A good fund manager, I always believe, and probably we'll talk about it some other time in terms of investment philosophy, what we call about risk-adjusted returns, that measure a portfolio manager not on his absolute return, but on the risk-adjusted returns, so as to you get a true picture to generate those returns, what risk he's taken. A good fund manager generates alpha on not only on the downside in the falling market, not only on the rising market, but also on the falling markets. So all I'm trying to say is don't try to time the market. That's my view, my principle, my philosophy. But get your asset allocation right and invest money in right set of funds. So for example, at this point of time, I will not put money in small cap funds. In fact, if I have money, I'll withdraw some part of it. When I'm allocating money to large cap, multi caps, I will invest in funds with low risk or moderate risk, and not funds which are running beta of 1.2 or 1.3, because I know that those funds, while they have done well in the last 6 months or 1 year, and that returns, significant part of those returns have come from high beta, which effectively means markets fall, those funds will fall much more sharply. So for the benefit of investors, meaning I don't believe in timing, friends. And if you get your other things right in terms of asset allocation, fund selection, then trust me, you don't have to worry about timing the market. Anyone who gets his timing right is lucky. There is no science to predict timing of the market. What will US Fed do tomorrow? What will Taiwan do tomorrow? What will Ukraine do tomorrow? What will Russia do tomorrow? What will China do tomorrow? There are 100,000 variables, and each of those variables has an impact on stock market. No one can predict those variables. It's humanly not possible. Anyone who gets the timing right is lucky, and there's no science to. I wish there was a science to predict market, to preempt and predict markets. But unfortunately, to my limited knowledge of my 27 years investing experience, I have not come across any such science, and which is why I don't even spend like 60 seconds trying to figure out the market, because we know that if we are owning the right companies, we are running a portfolio in the right risk framework. We have risk boundaries for our portfolio. Me or my fellow fund managers, none of them can exceed those boundaries. So as long as all of us can behave in a logical manner within the framework that we have set for ourselves, we are not bothered about timings of them, about the crisis or fall in the market, because we know that our portfolios are low risk portfolios. So that's the message. If you really ask me, Kamal, I thought I will share this because it will benefit all the investors, because if this is of interest to you, interest to all of them.
Thank you so much. And the reason we do these webinars every Friday is to obviously reiterate these messages to our clients, to investors, because obviously, over time, greed, fear creeps in. And it is important to keep remembering. And when they hear these messages, listen these messages from successful fund managers who are thought leaders, obviously that kind of, that gives them food for thought, that gives them, reason to think. And obviously that gives them comfort. And that is how they're able to sail through, good times as well as tough times. And that's exactly how they create wealth. And that is the essence of our wealth management practice that we have kind of created, where we say that we do deep diving and offer not just analysis backed quality investment offerings, like boutique funds, like Renaissance being one of them. Also, we handhold clients through such excellent sessions, through our content, and through such conversations. And while we were chatting, I could see a lot of investors were wanting to kind of contact us. I would just urge those investors to kind of go to our platform PMSAIF World, and you will find yourself at one of the most insightful platforms, which is specialized, which is focused in the space of alternatives. And you can book your appointment with us. We'll be absolutely more than happy to handhold you, to guide you, to help you invest in some of the finest portfolios. I repeat that because there are some few rare such fine portfolios which we know they exist. Though market is 95% in the hands of top brands, obviously they're also good. But yes, with regards to our clients, we are absolutely very, very selective in our approach, and we are quite insightful and quite confident in whatever we are saying. So you're most welcome to kind of spend maybe few hours of your precious time with us through fixing a appointment with us, and absolutely we'll demonstrate a lot of value add to your existing portfolio, to your future investments. Thank you for joining us today, and thank you, Pankaj, for giving your time.
Thanks a lot, Kamal. I must admit, I really enjoyed this conversation. It was wonderful talking. So I really enjoyed this conversation. I'm sure investors have benefited out of it. So thanks a lot, investors, for taking the time out and joining us. And thank you very much to you, Kamal, personally, for hosting this and doing this. Thanks a lot.
My pleasure.
Thank you. Bye-bye.